record. Okay. Okay. I think we are recording. Okay, good. So we are doing the chapter 7 and 8. We are focusing on the variance. Okay. So I'm going to show you a video. I made an animation while I was having the COVID, and I lost my voice. So that video wasn't the best I would have hoped for. There's no voice, right? So, but I'm going to talk about it. Before that, let's go through the 4 levels of the variance. Okay. So we are saying here at the top level, okay, you have a variance called static and budget variance. So what is this? So static budget, right? Static budget is you have a budget, but that budget is designed only for one specific level of the activity. Okay, so you may make a budget for producing like 1,000 pieces of the product, right? So that budget is static because it's only for one specific level of the production level. Okay, and then the actual cost versus that budget, right? That's the static budget variance. And then you have this variance can break into 2 variants. Okay, and so move on to the next level. So now we talked about the flexible budget. Okay, for the flexible budget, it's different from the static budget. Okay, the flexible budget, okay, that budget reflects the actual output, the actual sales. Okay, and then this static budget variance is broken into flexible budget variance versus sales volume variance. This will be very clear once I show you that video, the example. Okay, and for this flexible budget variance, it can be further break down into variable cost pool variance, selling price variance, and the fixed. This is the overhead pool. And for the variable cost pool, there are materials, manufacturing labor, marketing labor, and variable overhead, right? And then under each of this variance, there are rate variance and the efficiency variance. And under efficiency variance, there are mixed variance and field variance. So this is the 4 levels of the variance. So I'm going to show you the video I made. Okay, so I have to maybe as we watch the video, I have to stop just to show you, because this one has no sound. Okay, just share the screen. And where is it? Here. Okay, can you see the video?
Yeah.
Okay. So we are going to learn about the budget variance analysis. So we are using one example. For example, you are selling this bowl. Suppose the selling price. The selling price is $10 for each, and we assume that the variable cost is $6. So the contribution margin for per unit will be the 10 minus 6 equals $4. So what is the static budget? Static budget is for a particular level. Suppose we are selling 1,000 units. So your revenue will be 10,000. Variable cost 6,000, contribution margin will be 4,000. Okay. Suppose the fixed cost, okay, this is the fixed number, right? For the static budget, 2,500. So now your operating income will be 1,500, right? 1,500. So I'm just pausing here. Does that make sense? What is the static budget, right? In 2,400, we have learned this is only for one level of the activity. Right? So you are selling 1,000 units. So the revenue will be 1,000 times $10 each, $10,000, right? And $6 per unit, and you are selling 1,000, right? So that cost will be 6,000. And this fixed cost is 2,500, which is fixed under the static budget. Okay, so this is the static budget. These numbers on your budget is for 1,000 units. Okay. And now, what's the actual? The actual cost, the actual is they sell 1,100 units, selling price revenue 11,500. Okay, and the cost is 6,500. Okay, this is the actual numbers, right? And the contribution margin would be the difference, 5,000. And the fixed cost is 3,000. So the operating income is 2,000. Okay, so these are the actual numbers, right? This is our plan, right? We are hoping we are going to sell 1,000 units, and according to our budget, we are making probably $1,500. Okay, but what is the actual result? We are selling more. We are selling 1,100 units, and the bottom line is better, right? We are making $2,000. Okay, so now there's a variance. Okay, 1,500. 2,000, there's a variance, 500. Can anyone tell me, is this a favorable variance or unfavorable variance?
Favorable.
Favorable, right? You are happy that you have more money on your hand, right? Your plan, you are making 1,500, but you are making more now, right? 2,000. So this is a favorable variance. What's the name of this variance? This is the static budget. This is the actual result. So this variance, what's the name of this variance? This is the level 0, right? The top level variance. What is it?
Static
budget
variance.
Yeah, that's correct. So this variance is the static budget variance. Okay, and like we mentioned, we know that this difference, $500, is favorable. We use the letter F. Now let's see, we can further break down the variance into two components: flexible budget variance versus sales volume variance. So in order to break this down, I created a middle column called the flexible budget. Flexible budget is gonna calculate these numbers based on the actual sales number, 1,100 units. Okay, so you can see that the static budget, those numbers, is based on 1,000 units. So for the flexible budget, okay, my numbers will be based on the actual output, 1,100 units. So $10 per unit. Now we are saying 1,100 units. So my revenue should be 11,000. The cost is 6 per unit. So 1,100 units, that will be 6,600 cost. Okay. So my contribution margin is 4,400, and the fixed cost is the same. Okay. Regardless, it's a static budget or flexible budget, the fixed cost is the same. Do you know why? Why the fixed cost is the same, 2,500?
Because
no.
it's
Yeah.
like it's not variable. That's just the fixed cost, no matter what number of units every month.
Exactly, right. So even though you are making more units, as long as it's in the relevant range, the fixed cost is still fixed, right? So that's why, even though you can see the revenues, the costs are increased, but my fixed cost is the same as the static budget. Okay, 2,500. So this gives me a 1,900 operating income. Okay, so what's my flexible budget variance? So I'm going to use 1,900 minus 2,000. So I have a $100 favorable flexible budget variance. And then I use 1,500 minus 1,900. I'm going to have a $400 favorable variance, right? So this called sales volume variance. Why I make extra $400? Why? Because you sell 100 more units. Each unit you make $4, right? Each unit, the contribution margin is $4. So when you sell additional 100 units, you are making additional $400, right? So that's why this variance is about the sales volume, right? So we are saying this is your sales volume variance, $400 favorable. This is a typo here. It should be F, not a U here, okay? So you can see that 100 plus 400 together, that's the 500, right? So we're saying at the top level, static budget variance is $500 favorable, right? But I can break this down into two sub-variance. One is called sales volume variance. The reason why I'm better off with $500 is because I sell 100 more units, so I better off with $400, okay? And the other one is the flexible budget variance, it's $100 variance. Together, that's 100 plus 400 is 500, okay? Okay, I'm gonna stop here. Does anyone have any questions about this so far? If this is good, give me a sum up. I can move on. Okay, very good, awesome. Okay, so this is the you learn the static budget variance, flexible budget variance, and the sales volume variance. Did anyone watch this video already?
I watched it like a long time ago.
Okay. Did you catch this
Same
typo?
here.
Yeah, but I understood what you meant because it was green and anything that's a negative number is favorable. So I caught that.
Mm-hmm. Very good. Okay, so I will keep going. Okay, so now for this flexible budget variance, I'm going to further break down this one, the $100 flexible budget variance. The first one is the selling price variance. Okay, so what is the selling price variance? So now we are comparing flexible budget, right? We are comparing the pink versus the black, right? The middle column versus the red column. So that's the 1900 minus 2000. That's your $100 favorable variance, right? So now you can see, you know what adds into this 1900, right? There's 11,000, 6,600, right, and the 2,500, right? So basically, what's the selling price variance? You are comparing the pink and the black. So 11,000 versus 11,500. Okay. So is this favorable or unfavorable?
It's favorable.
Because you are making more money, right? So you are receiving, actually, you are receiving 11,500. Very good. So this would be a 500 favorable. Okay. And then fix the cost pool variance. So you are comparing 2,500 versus 3,000 here, right? So this is an unfavorable variance. Why? Because cost, you are planning the cost will be 2,500. It's actually cost you 3,000, right? It costs you more, so it's unfavorable. So that's 500 is unfavorable. And then the last one is the variable cost pool variance. Now you are comparing the 6,600 versus the 6,500. Again, the cost is more, therefore, sorry, the cost is less, right? So you were thinking it's going to cost you 6,600, but it's actually cost you less, 6,500. So that's the 100 favorable. So if you add these three together, okay, 100 favorable, add 500 unfavorable, add 500 favorable, together it's going to be this 100 favorable because these two canceled out, right? These two canceled out. Does this make sense?
Yes.
Okay. So we are going to keep going, right? The different levels. Now let's go to take a look at the variable cost pool variance. Okay, the blue color. So before that, we need more information. We want to see what are the components for the variable cost, right? So we know variable cost has direct materials. Suppose that's $2. Okay, $1 times 2 units. Direct manufacturing labor cost. So that's $12 per hour times 0.1 hours. So $1.2. Direct marketing labor. So the people we pay the marketing people $10 per hour, it takes them 0.2 hours to sell it. So that's $2. And the variable indirect overhead is $8 times 0.1 hours. So that's the $0.8. So total, that's the $6. Because remember, the variable cost is $6, right? So in the very beginning, the selling price is $10 and the variable cost is $6. So this gives you more information. What adds up to this $6? $2 direct materials, because each materials, we need to input $1 and we need 2 inputs, right? So that's the $2. The labor, $12 per hour, and each unit takes 0.1 hours, 1.2, and 2.0 for the marketing, and variable overhead 0.8. So these numbers add up to the $6. Okay. Okay, now what's my flexible budget? Can anyone tell me how do I figure out this flexible budget? Okay, so here it's 1,100 units. So easy, right? Just use these numbers times 1,100 units, right? So that is your $6,600, right? So now you just use these numbers, right? These numbers multiplied by, because these numbers are per unit, right? Multiplied by 1,100 units. So that's how you get the flexible budget, okay? And now your actual numbers. Okay, so the actual numbers, you can see this black is different from the pink color. Okay, so in this video, in this part, okay, just give me a second. Okay, so you can see that the variance we are trying to explain is between 6,600 and 6,500, right? That's the variable cost variance, the $100 favorable variance, right? And now you can see it's further break it down, right? It's further break it down into materials, manufacturing labor, marketing labor, and direct overhead. So now you can compare all these numbers, right? So for direct materials, you are going to compare the variance between direct materials, right? Can anyone tell me what is the direct materials variance? Is it favorable or unfavorable?
Favorable. Favorable.
Favorable. And
Favorable.
what is the amount of the variance?
And 200 minus
$200.
550.
How do you do the calculation?
550.
2,200 minus 1,650.
Okay, good. So you are comparing the pink versus the black, right? The black. So now remember these numbers, right? And you're gonna see how it's further break down, right? So now take a look. I'm breaking this down into another 4 level. So first one is the direct materials variance. Okay, so I use 2200 here minus 1650. So that's a 550 favorable. And the next one is the direct manufacturing labor variance. So I'm going to use 1320 minus 2420. So that's unfavorable. That will be 1100 unfavorable. And the direct marketing labor variance. So you use 2200 minus 2200. So this is 0, no variance. And the last one is the variable overhead. So that's the 880 minus 230. So that will be 650 favorable. Okay. Does this make sense? So I'm moving into another layer variance. Does this make sense? Okay, good. It's much better with me explaining it, right? Rather than you just watch this video. So now we can further, okay, we can further break it down. This, let's take a look at direct materials variance, okay? So I want to compare 2200 versus 1650. Now focus only on this, 2200 and 1650, okay? So let's take a look. So I'm going to break this variance into a direct material rate variance. And here will be a direct material efficiency variance. Okay. So we are going to use this. You have seen this in the 2400. So on the left side, I set up using the actual input times actual rate. Okay. So the actual input is 1.0 times 1100 times 1.5. So that's my 1650. And the budget input for the output times the budget rate. Okay. So we have 2 times 1100 times 1 equals 22. Okay. So that's the 2200. This is the 1650. And in the middle, we are using the budget input for actual output times budget rate. Okay. So here would be 1.0 times 1100. So that's it. So I had to explain this here. Okay. So for this direct materials, okay, this direct materials, so the input here is 2, okay? So for each output unit, okay, that's the bowl, right? That's the product. I need probably 2 pounds of clay, something like that, right? And each pound of clay is gonna cost $1. That's what this means, okay? So what is the input? In this case, that's the materials, the clay, right? What's the output? The output is the bowl, right? So for each bowl, we are saying here, I'm going to need 2 pounds of clay. That's this 2 mean, okay? This is my budget. This is my budget, right? And each pound of clay is going to cost me $1, right? So for each bowl, 2 pounds, and each pound costs $1. So that's the $2. That's my direct materials. But actually, what happened? Okay, actually, what happened? I actually only need 1 pound of clay. Okay, instead of 2 pounds, I only need 1 pound of clay, and each pound costs $1.5. Okay, you can see the actual numbers are different from the budget, right? And then the total per unit cost is $1.5. Okay, so here when we are saying actual input times actual rate, okay, actual input is 1 pound, right? for each unit, and there are 1,100 units. So 1 pound times 1,100 units. So I need 1,100 pound, and each pound cost, the actual rate is $1.5. So this is the 1650. Okay, this is my actual number. And for my budget, okay, the input is 2 pounds per unit, and there are 1,100 units. And each pound, the budget rate is only $1. So that's my 2,200. Okay, so and actually you just use these two numbers, 1650 and 2,200. The difference is the 550 favorable variance, right? But I want to explain this 550 favorable variance by having something in the middle. We call this, we are going to use the budget rate and the actual input. Okay, we are going to use the actual input for the actual output production, 11,000 units. Okay, so here the 1 pound, right? That's the actual input. This here must be a typo here. So 1 pound times 1,100, right? That's how many pounds of the materials you need. But you times the standard rate. The standard rate is not $1.5. The standard rate is $1, right, per pound. Okay, so then you figured out that there's this number in the middle, 1,100. Okay, so when you compare the middle column to the right column, 1,100 versus 2,200, the rate is holding constant. So basically, you are saying the budget rate is the same, right? It's all $1 per pound of the clay. So what's different is the usage, right? The amount of materials used. Okay, so you need in your budget, you need 2,200 pound, right? But actually, you only need 1,100 pound, right? This is the efficiency, right? You use less materials to make the same level of the output, right? So therefore, when you take the difference between 1,100 and 2,200, we call this efficiency variance. So this is the efficiency variance. Basically, you are using less materials, okay, for the same level of production. When you compare the first two numbers, 1650 and 1,100, you can see that the materials level is the same. It's all 1,100 pound, right? But the rate is different. The actual rate is $1.5 per pound. The budget rate is $1 per pound, right? So the actual rate is higher, right? 1.5 versus 1. So the actual rate is higher. So therefore, you are going to have a favorable or unfavorable rate variance if the actual rate is higher than the budget rate. Are you going to have a favorable or unfavorable?
Unfavorable.
Unfavorable, right? Okay, so then you take the difference. 1650 minus 1,100, you're going to have a 550 unfavorable rate variance. Together, you have 1,100 favorable. That's kind of like a positive. And you have a negative minus 550 unfavorable. Together, this 1,100 minus 550, that is a 550 positive favorable. Yeah, so that's how we are able to explain the 2,200 minus 1650, this 550 favorable. We can break it down into a rate variance versus a efficiency variance. Okay, does this make sense? Okay, let's do this. This is very important because I'm going to walk through some more examples later on. Okay, so 1, 2, 3, sum up, please. Okay, yeah. Okay, pretty good. Okay, so and then this is almost the end of the video. So this, you can see how I calculate the direct materials variance. So again, this 1100 favorable, that's the efficiency variance. And this 550 is unfavorable, which is the rate variance. And then you are going to do the same thing for this labor variance, right? You can also break the labor variance into a rate variance versus efficiency variance. And the calculation is exactly the same as we have done for the materials. So you can see this is another labor variance for the marketing people, right? Again, with the information we are doing, you can use the same approach to compare that rate variance and the efficiency variance, okay? Okay, so I'm gonna stop this one.
Yeah, I'm gonna.
Okay, does this make this? I hope this makes sense. It's too bad that I lost my voice, but otherwise, if it has voice, maybe it's better for you to review that video. Without sound, do you find it's hard to follow the video?
Sort of.
Yeah.
It was quite fast.
Yeah, I'm not surprised by that. Yeah, so and it may be very challenging, but you get the point, right? So that's what we are doing. Just give me 1 second. I have to let me stop share here, and I'm going to share the PowerPoint. Where is it? Here. Okay, so we are back to these slides, right? So now take a look, right? This probably makes more sense to you now, right? After watching the video. So you start with the level 1, level 0, static budget variance, and this will be break down into a flexible budget variance and sales volume variance, right? And this flexible budget variance is break down into a selling price variance, variable cost, and the fixed cost pool variance. And under the variable cost pool, there are direct materials variance, manufacturing labor variance, marketing, and then you have rate variance, efficiency variance. Okay, so I just use that one example to cover this picture. Okay, so I hope that you are comfortable with this. And then we are going to do some problem together. We probably will not. I'm trying to keep the lecture short, as part of helping you to, have more time to study. So we are doing the first question. This one is, which question is this? This one is the 7-41. Did anyone have done this question by yourself? How many of you studied during the strike? Studied this course and by yourself?
I definitely did
studied.
not.
I had
I
COVID.
studied the first week and then I stopped. So the last 5 weeks I haven't done anything.
Okay, yeah. Take a break.
Yeah, I studied and now forget.
Okay, yeah. Okay.
Same year, first few weeks. That's it.
Okay, yeah, fair enough. Yeah. So here for this question, 7-41. By the way, I have the solutions posted already, right, before the strike. So this question is about a company manufactures shirts for retail chains. The controller is becoming increasingly unhappy with the new fashion standard costing system. The budgeted and actual amounts for direct materials, direct manufacturing labor for June were follows. So basically you have information here, budget amount and the actual amount, the 2 columns. And you have the units of the shirts manufactured. What's the direct materials cost? Direct materials unit. So this will be the rolls of the cloth and direct manufacturing labor cost and direct manufacturing labor cost hours, okay? There were no beginning or ending inventories of materials. Standard costs are based on a study of operations conducted by an independent consultant 6 months earlier. So the controller observes that since that study, he has rarely seen an unfavorable variance of any magnitude. He notes that even at their current output levels, the worker seems to have lots of time for sitting around and gossiping. The controller is concerned about the production manager. Charlie is aware of this, but does not want to tighten up standard because the lax standards makes his performance look good. The first question is here: compute the rate and the efficiency variance of the company for direct materials and direct manufacturing labors in June. Okay. So tell me first, what is the output in this context? What is the output, the stuffs this company is producing? What is the output?
Rolls, 600 rolls.
600 rolls. Okay. Anybody else?
Shirts.
Shirts. Okay. Yeah. So they are here. They are saying they manufacture shirts for retail chains, right? Here, manufacture shirts. So that's why I'm asking you. This is important. You have to be clear. What is the output? What's the input? So, oops. So the output are the shirts, right? What is the input?
Rolls.
That's the materials, right? And the materials
Direct material and direct
and,
labor.
and labor, right? That's the input, right? So let's be clear on that. Okay, so now I want to ask you, what's the actual price for the material? What's the actual price for the material? So you have to be able to, find the information you need, right? But in this table, what is the price for the material? Actual
That's the 30,294.
Yes, very good. Okay, so the actual, okay, the actual cost, okay, that is for the direct material, that's 30,294, right? So this will be on your left column, right? So when you try to figure out the variance, the rate variance and the efficiency variance, remember there are 3 columns, right? And the actual cost is at the left column. So this number is given, okay? And then I want to know what is the red column. Can anyone tell me what is this red column here? You remember?
Is that the budgeted?
Budgeted?
Flexible budgeted.
Okay, yeah, flexible budgeted. Yeah, very good. So this is a flexible budget. Okay, so the budgeted input allowed for the actual output times budget rate. Okay, so we have to know what's the budget rate, and we have to know what's the budget input for the output. Okay. So this is very interesting here, right? What's the budget rate? Okay, and what's the budget input for the output? We are talking about the materials, right? So we are talking about the rows of the cost. That's the input. And the output is the shirts, right? Okay. So first question, how many inputs for a shirt, right? For output. You want to know the conversion, right? How many input you need in order to make one output? So in another way, how many rows of cloth, that's the input you need for one shirt, right? You need to know that. And you also want to know that what's the cost, the budget rate. Basically, that's the cost of the input, right? So for each row of the cost, right? What is the price? What's the cost, right? How do we know this? Can anyone tell me? How can I know this information?
600 rolls divided by 6,000 shirts that was budgeted to make.
Okay.
It's per shirt material input.
Okay, good. How about the budget rate?
So the $30,000 divided by the 600 material.
Very good. Yeah, that's exactly correct. So this will be my approach. So with the budget information, right? Because for on the right column, you are using budget information. Okay, it will be wrong if you start looking into this actual amounts, right? This right column here, you use the budget information. So we know that they are thinking they are going to make 6,000 shirts, and they are going to need 600 rolls of cloth, and it's going to cost them 30,000, right? This three information. So when I translate this, that tells me that each shirt is going to need 0.1 unit of the roll, right? And each roll is going to cost $50. Okay, so 6,000 shirt times 0.1, that's the 600 units. So the student is exactly right. Who gave me the answer? Sorry, who just answered my question?
Makiko here.
Oh, thank you. Yeah, you are absolutely right. So you use the input 600 units, that's the rolls, divided by the output 6,000. Okay, that's equals 0.1. So that's how much input for 1 unit of the output. Okay, and then the total cost is 30,000, and the number of the rows is 600. So for each row, you use 30,000 divided by 600. That's $50. So basically, each row will cost you $50, and 600 rows is going to cost you 30,000. Does this make sense? Okay, 1, 2, 3. Okay, very good. So it's very important, right? You are able to think through this, right? Okay, so now tell me what is the budgeted input allowed for output, actual output. So what is the budgeted input allowed for the actual output? So first tell me what's the budgeted rate, the price.
$50.
$50, very good. So how do I calculate budgeted input allowed for the actual output? What's the actual output? Can anyone tell me? What's the actual?
6,732.
6732.
Very good, right? Because when you talk about output, you're talking about shirts, right? So the actual amount of shirts is 6732, right? Yeah. Okay, so how many input that's going to be you are going to allow? How many input according to the budget will be allowed to make the actual 6732?
6,732 into 0.1.
Yes, very good. So you use the actual output, right? This is much shirt, and each shirt is going to need 0.1 row of the cloth, and each cloth is going to cost you $50. So that is your budgeted, right? According to your flexible budget, this is how much the direct material cost will be. Okay, is this clear? It's important you understand this. Is this clear?
Yes.
Okay, good. Okay, now tell me what should be in the middle, right? You have to have something in the middle.
Actual input quantity times the budgeted rate.
Okay, very good. You use the actual input for the output, right? And then times the budget rate. That's the key. So what is the actual input?
612 direct material units rolls of cloth is the actual times, I think, the $50.
Bingo. Okay, very good. So you use actual input quantity, right? So that's the 612, right? And you times budget rate, 50. So that's your middle number, okay? Okay, so you tell me what is the rate efficiency, sorry, what's the rate variance? Is that a positive or is that a favorable or unfavorable? I'm saying rate efficiency, sorry, rate variance.
Favorable.
Favorable?
Positive.
Favorable.
Favorable? Okay. Favorable. Why? Robert? Bob?
It's positive by 306.
306. Okay, let's take a look. Yes. So the rate variance, you compare the left and the middle, right? So this is a favorable 606. Okay. And when you compare the middle column versus the right column, this is the efficiency variance. Okay. And it is favorable. Okay, favorable. So basically, this is the materials, that's the cost. The lower the number is, the lower the better, right? So this number 3,600 is lower than 33,660. So that means this, when you compare this to this, the actual, this is a better number, so you have a favorable variance. Okay. So what we are saying is, you are thinking to make 6,732 units, you're gonna need 673.2 rows, right? But actually, you only used how many? 612, right? Instead of 673, right? So you are more efficient in using the materials. So you have a favorable efficiency variance. Okay. Okay, does this make sense? Okay, 1, 2, 3. Okay, good. Okay, so now let's do the direct labor. We just finished the direct material, right? Now let's do the direct labor. Okay, so I'm gonna set it up exactly the same, but this time I'm doing labor, right? But I still have the same 3 columns. Okay, so someone can tell me what's the actual cost on the left column. Remember,
27.
participation. Okay, sorry, what's the number?
27,693.
Yeah, so you find it. Yeah, that's this number, the green color, right? 27693. That's the actual labor cost. Now, I have to go through this again, right? I need to know, okay, what is the input, right? And how many inputs for each output, right? How many units of input? That's the labor hours, right? For each output. And what is the input price? That means the labor cost per hour, right? Okay, so do we have that information?
Yes. Oh, we can get it just like the last time. That would be 27,000 divided by 1,500. We get our rate.
Yeah, very good.
That is 18.
Yeah, very good.
And then we take the 1,500 hours divided by the 6,000 shirts to get the 0.25 hours for your budgeted direct manufacturing labor hours per unit.
Awesome, awesome. Thank you. Very good. So you can see I use the purple color for those 3 information you're going to need to figure it out. Okay, 6,000 shirt will need 1,500 direct labor hour. Okay, so that's the output. The shirt is the output. Direct labor hour is the input, right? And this total cost is 27,000. This tells me each shirt will need 0.25 direct manufacturing labor hour, and each direct labor hour, manufacturing labor hour costs $18. So how did I get 0.25? You use 1,500 divided by 6,000. how do I get $18 per hour? You use 27,000 divided by 1,500. Okay, so now tell me, oops, no. Okay, now tell me, how do we calculate this number on the right side?
That would be 6732 into 0.25 into $18.
Yeah. So you use the actual output, 6732 shirts times 0.25. This tells me how many manufacturing labor hours is going to need, and times the $18 per hour. This is my cost, right? Okay, in the middle, anyone can tell me how do I calculate this number in the middle?
That's gonna be 1530 times the $18.
Yeah, very good. So the actual direct labor hours, that's the 1530, right? And the standard rate is 18, right? So 1530 times 18, that's in the middle. Okay, now, do we have, what is my efficiency variance? Favorable or unfavorable? Efficiency variance.
Favorable.
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 By how much?
2,754.
Yeah.
Okay, let's take a look. Yeah, 2,754. Awesome. Wow. You guys are doing great. So you take the difference, use this number minus this. So this will be 2754. The fact that this number is lower, right? The actual, this is lower than the budget. Lower than the budget, that means the cost is lower is better. That's why it's favorable. And when you compare it to the rate, this is actual, is higher than this number, the budget rate, right? So that means the actual rate is higher than the budget rate. That's why this number is higher than, the green number is higher than the middle number. So that's why it's unfavorable. So by 153. Okay, so in the final exam, I promise you, you're gonna see questions like this. Okay, I promise you. And you probably won't be surprised, right? So do you think you will be able to handle a question like this in the final exam?
This is going to be like 6 questions.
It's just one question, right? Asking you rate variance or efficiency variance. Okay, I'm going to stop so that I don't make this video too long. Stop.